question is that the amendment be agreed to, and I call the honourable member for Blair.
Thank you, Deputy Speaker. The legendary US President Franklin Roosevelt said this: "Here is my principle. Taxes shall be levied according to ability to pay." That is the only American principle. It's an Australian principle too. It's a fair principle. Taxes are levied according to the ability to pay. So the legislation before the chamber today is about fairness, not just about revenue. It's about making corporate Australia pay their fair share of taxes. So I'm pleased to speak on this particular bill, which is about transparency and integrity and making multinationals pay their fair share of tax. Just as FDR during his New Deal saved American free enterprise, we need to make sure that the integrity of our taxation system is such that it saves free enterprise in this country and elsewhere. It's absolutely critical. Australians rightly expect that all taxpayers, from the largest multinational to individuals, pay their fair share of tax. Our system of taxation, our system of government revenue, our system of government expenditure relies upon this. Now, it's said that the legendary US Supreme Court Justice Oliver Wendell Holmes was often cited for that famous statement that taxes are the prices we pay for civilisation. That was nearly a century ago, and FDR made the point on a number of occasions that some people, including some opposite, if you listen to the previous speech, think that to individuals civilisation comes at a discount. It doesn't. We all have to pay our fair share of tax. That's the reality. And in that country, the United States, they brought in corporate taxation back in the robber baron era in the 1890s as a response to the outrageous and excessive profits and treatment of workers, but the failure to pay their fair share of taxation. Regrettably, the US Supreme Court struck down those efforts in 1898, but they brought in a corporate taxation rate in the US in about 1913, but can you believe it? It was a 1% rate of tax. Now, we brought our own corporate taxation in, and when Billy Hughes was the Prime Minister in 1915, and he made the point, and it's not often that I quote a bloke that ended up ratting on the Labor Party, but he made the point that it was really a necessary way to raise income. So the main purpose of this particular legislation is about making sure that corporate Australia and multinationals pay their fair share of tax. And it's the case that it's estimated that hundreds of billions of dollars are lost around the world by reason of the fact that there are really corporate shenanigans that are undertaken by multinationals to create shell companies and make sure that profits are directed to areas where, in fact, there is really no corporate presence in terms of an office, no employees, but they are low taxation jurisdictions. So debts levied and put on areas where there is considered to be, from multinationals, a higher rate of corporate tax, and to make sure that that excessive debt is put on there, and to make sure that profits are directed to the low jurisdictions to ensure that little or no tax is paid. So this sort of excessive debt loading is thin capitalisation, and multinationals do this and do it successfully. Now, if you listen to those opposite, you would think that they were the champions of taking action in this area, but in fact little was being done, and it's left to us in government to pass this type of legislation. And one of the reasons we announced that we would do this, the now Assistant Treasurer, we did this in the election campaign, was the fact that nothing was being done by those opposite during their dithering 10 years in office. So that's left to us in government to make sure that corporate Australia particularly pays their fair share of taxation. And as I say, it's not just about much-needed revenue, but it's also about fairness, and that's why it's absolutely critical. So we need to work through the OECD arrangements. We already have a thin capitalisation system in this country, and it goes back to the days when Bob Hawke was the Prime Minister of the country in 1987. Our current regime was introduced in 2001 and needs updating, of course, because it's now contained still in the Income Tax Assessment Act, and it's designed to prevent multinationals from claiming excessive debt reductions to reduce their taxable income in this country. And the actual rules operate in a pretty clear way. Disallows a portion of otherwise deductible interest expenses where the debt allocated to Australia exceeds certain limits, and the safe harbour arrangements at 60% in relation to those issues. So this legislation is really important because it puts an emphasis away from the current ratio of debt to equity and picks up the recommendation it's on earnings in terms of what taxation should be levied. So it recommends, and we work with the OECD arrangements to ensure that we undertake a situation where tax is linked to income as opposed to the allowance of complex corporate subsidy arrangements and subsidiary aspects being undertaken to ensure that that debt is funneled or passed off to low jurisdiction in terms of tax. It's about tackling tax, not avoidance, but really tax evasion. It improves the coherence, I think, and our contribution to international tax rules and ensures a more transparent tax environment. Now, these policies are grounded in the OECD, as I referred to, and the G20 inclusive framework and the base erosion and profit shifting, or the BEPS, which began in 2013. Working together within this inclusive arrangement, about 135 countries and jurisdictions are collaborating on the implementation of measures to avoid tax, to tackle tax avoidance or evasion, improving the coherence of international tax rules and ensuring a better tax environment. This, as I said, fulfils a commitment we made in the 2022 election campaign. Now, we've got a record of standing on significant reforms in the area of tax in terms of multinational taxation and tax transparency. In fact, it was then Assistant Treasurer David Bradbury who led Australia's contribution to the debate on base erosion and profit shifting at the time of the last Labor government and implemented key reforms in the area of tax transparency, including the landmark amendments to the General Anti-Avoidance Rule and modernisation of Australia's transfer pricing laws. Of course, David went on to join the OECD in 2014. I was pleased to catch up with him in Paris last year when I talked about the work he was undertaking in this area. He's part of a team that delivered the OECD G20 base erosion profit shifting project. He's contributed mightily, can I say, David, to the OECD's work in securing a groundbreaking international tax agreement to address challenges arising from the digitisation of the economy. More recently, Labor and opposition recognised there was still work to be undertaken, improving tax transparency and the failure of the previous coalition government letting off multinational companies off the hook when it comes to taxation. So we've sought a mandate to undertake this work to improve tax transparency by listed corporates, government tenderers and billion-dollar multinational companies, and we're committed to making sure that we deliver on this promise. The bill carries into effect our commitments in the 2022 election campaign and also the commitments and undertakings we did in the October 2022 budget as part of our multinational tax integrity package to address tax loopholes exploited by those companies. And this investment in tax compliance will improve the integrity, transparency, fairness and sustainability of our tax system. And we're committed as a government to doing this. Schedule 1 amends the Corporations Act of 2001 to introduce new reporting requirements for Australian public companies, both listed and unlisted, to disclose information on their subsidiaries in their annual reports. And this reported information will ensure companies are upfront about how they structure their subsidiaries, including tax purposes. Under new tax transparency requirements that will be introduced from the 1st of July this year, public companies will need to disclose their subsidiaries and where they're based. Large multinationals will need to disclose certain information on a country-by-country basis in their approach to tax, and tenderers for large government contracts will need to disclose their country of tax domicile. Improving transparency in this way is important to ensuring the public is better informed of the multinational companies' tax arrangements. And these reforms will help hold companies to account, particularly large corporate groups, on their corporate structures and whether they are operating with opaque or atypical tax arrangements. Given the global momentum towards ensuring that these firms pay their fair share of tax, it's in the public interest that shareholders have this kind of information. Ultimately, we hope this will drive behavioural change amongst large and highly profitable corporations about how they view their taxation obligations, make them more accountable to their shareholders and improve and make fairer, I might add, tax planning strategies. Schedule 2 is about revenue raising the thin capitalisation, and prior, as I say, to the last election, we pledged to close down the multinational tax loophole about debt dumping, as I explained earlier, and Schedule 2 delivers on that commitment. These provisions amend our thin capitalisation rules to limit the amount of interest expenses that entities can deduct for tax purposes from the 1st of July this year. This tax integrity and revenue measure is estimated to gain about $720 million over 4 years from this year. These amendments introduce earnings-based interest limitation rules for general class investors to replace the existing asset-based rules and a new third-party debt test. The current safe harbour test lets an entity deduct all interest expenses where their total debt amount does not exceed 60% of their total asset value. Under the new default fixed ratio test, all interest expenses can be deducted where net interest expenses do not exceed 30% of profits. And this reflects this government's immediate priorities to strengthen the thin capitalisation rules, to stop excessive debt reduction and ensure that deductions are genuinely linked to economic activity and an entity's earnings and taxable income, rather than allowing deductions on falsified debt structures. This is a more robust approach in addressing the use of debt as a base erosion and profit-shifting risk, and it's consistent with the OECD's best practice framework to limit debt-related deductions based on earnings. The bill reflects several technical changes proposed by industry under consultation to provide a better balance with commercial arrangements, including trust structures. So these arrangements and these amendments strengthen our thin capitalisation rules. They'll ensure multinationals pay an appropriate amount of tax in Australia while balancing tax settings. The measures bill reflects several rounds of public consultation, as I referred to balance the integrity of the system. There have been broad support for the reforms from industry, from unions, from civil society groups. Treasury will continue to work with stakeholders to make sure the new rules operate as intended. In response to concerns by some section of the business community, the government will continue to engage with stakeholders on our commitment to introduce a public country-by-country reporting regime. Over the coming months, we will consult further on appropriate levels in terms of reporting. This will build on refinements that have already been made to align our system with the European Union's public country-by-company regime. The government will continue to work alongside the ATO to create a system that's fair, transparent and consistent, and make sure these biggest companies are held to account. These commitments complement the government's ongoing engagement with the OECD's two-pillar global tax agreement, which includes a global 15% minimum tax, ensures some of the profits of the largest multinationals, particularly digital firms, are taxed where the products or services are sold. And like those opposite, we won't allow multinationals to get off the hook when it comes to their tax obligations. The former coalition government was happy to praise the global efforts of the OECD and others, but took no meaningful steps to ensure that multinationals pay their fair share of tax in the countries in which they make their profits. Again, these commitments that we're making are targeted, they're measured, without imposing unnecessary burdens on genuine business activity. The government understands that businesses of all sizes make important contributions to the economy. We want to see businesses grow. Closing multinational tax loopholes will create an environment for products to flourish and productive firms to continue to grow, while improving our government services, the corporate services, including government and corporate products. We're going to improve public confidence in our tax system. I note the bill was referred to the Senate Economics Legislation Committee for an inquiry which reported back on the 31st of August, and most of those submissions seem supportive of this particular measure. I want to thank the Assistant Minister for Competition, Charities and Treasury. He's been an advocate for this for quite a long time, and I support him. I commend him. I commend the legislation to the chamber.
The question is that the amendments be agreed to, and I call the honourable member for Sturt.